Welcome to this explainer. Today, we are diving into a massive structural shift happening across healthcare and finance. For decades, the biological process of aging was treated as just an academic curiosity, a theoretical thing confined to laboratory mice and petri dishes. But as of June 2026, that has fundamentally changed. We're going to unpack exactly how geroscience has crossed the boundary into a highly investable, regulated, translational market. For the investors tuning in, this is all about understanding the platforms, the pipelines, and the venture capital that are literally turning longevity biology into clinical reality. Here's our roadmap for today. We'll cover the fundamental scientific paradigm shift, follow the money into clinical mega-rounds, explore how investors actually measure biological ROI, map out the VC ecosystem, and finally, size up the macroeconomic prize. All right, part one, the paradigm shift. Let's get right into the foundational scientific pivot making all of this possible. For the last century, modern medicine has essentially been playing a giant game of biological whack-a-mole. We wait for isolated age-related diseases like Alzheimer's, heart disease, or cancer to pop up, and then we try to treat the symptoms. But the new paradigm, the one attracting billions in venture capital right now, it's all about targeting the upstream biological drivers of aging itself. It's an incredible shift from reactive sick care to proactive preservation of function. We are no longer just fighting the symptoms of isolated diseases, we're funding therapeutics designed to repair the biological engines of aging, aiming to prevent multimorbidity before it even starts. Moving on to Section 2, Funding and Mega Rounds. To really grasp the sheer scale of this emerging market, we've got to follow the money and look at the VC validating these preclinical hypotheses. Just let this number sink in for a second. $1.8 billion. Retro Biosciences recently hit this massive valuation following a financing round led by 4P Capital. And remember, this isn't for a new app or a software-as-a-service platform. This capital is dedicated to pushing their lead program RTR-242 directly into human clinical trials. Retro is officially a clinical stage company. What's truly fascinating here is the specific mechanism they're funding, something called autophagic flux. Think of autophagy as your cell's internal recycling program. It clears out damaged proteins and cellular debris. In neurodegenerative diseases like Alzheimer's, this recycling network essentially breaks down, leading to the buildup of toxic amyloid and tau aggregates. Well, Retro's drug is an oral small molecule therapeutic designed to boost this exact recycling process. They're already in phase 1 trials with no observed dose-limiting toxicities, and we're expecting early human safety data by August 2026. Oh, and a fun fact? They are also collaborating with OpenAI using GPT-4b deep learning models to engineer novel proteins. This is literally where cutting-edge biotech meets artificial intelligence. In a parallel mega round, we saw NewLimit lock down a totally impressive $435 million Series C financing. And this wasn't just your niche biotech crowd either. This round had major backing from powerhouses like Founders Fund, Thrive Capital, and Eli Lilly Ventures. Listen, when Big Pharma's venture arm steps in at this scale alongside top-tier Silicon Valley capital, you know the translational potential is incredibly serious. So what exactly is that $435 million paying for? It's funding epigenetic reprogramming. NewLimit is taking the exact same lipid nanoparticle, or LNP technology, that delivered the COVID-19 mRNA vaccines, but instead, they're delivering proprietary transcription factors to reverse the biological age of old human liver cells. Preclinical models actually showed this restored youthful metabolic plasticity in older livers. They're gunning for a phase 1 clinical trial in 2027 to combat fatty liver disease and metabolic syndrome, which is a cluster of conditions affecting roughly half of everyone over 60. It's just wild to think they are quite literally trying to reprogram your cells back to a youthful operating state. Taking a step back to look at the broader clinical pipeline, you can see the leading asset classes within longevity biotech are clearly defined right now. Feel free to grab a screenshot of this. You've got Life Biosciences in phase 1, actively dosing human patients with viral gene therapy to reverse vision loss and glaucoma. We just talked about Retro and NewLimit. And check out that bottom row. Beijing 301 Hospital is running a massive phase 2 and 3 trial with 2,000 adults using umbilical cord stem cells. But here's the kicker. It's not the cells themselves doing the physical repair. It's the secretome. That's the cocktail of anti-inflammatory proteins they secrete to target physical frailty and sarcopenia. Make no mistake, the science has definitively left the lab and entered the realm of regulated human trials. All right, Section 3, measuring ROI through biomarkers, because obviously sophisticated investors and clinicians can't just throw billions of dollars at aging without a real way to track the results. Recent clinical datasets have proven that biological aging is not just a slow, linear slide. It actually happens in sequential, distinct stages. During Phase 2, for instance, researchers at the Leibniz Institute discovered a massive driver of cellular decay is the systemic decline in the synthesis of a lipid called phosphatidylcholine. When this drops, your mitochondrial membranes literally become rigid. They can't fuse or share energy. The researchers compared it to a municipal power grid where broken connections cause localized blackouts. This metabolic rigidity drives systemic fatigue. And interestingly enough, metabolic data shows this drop is super pronounced in women around menopause, which gives us a clear biological explanation for that specific energy loss. So, how do we track these stages of decay or, conversely, the success of a longevity drug? The industry relies on epigenetic clocks. You can think of these as the primary KPIs for clinical ROI. We're way past the first-generation clocks that just took a guess at your chronological age. Today, the gold standard is second-generation clocks, like PhenoAge, which predict actual mortality risk and are highly sensitive to things like diet, exercise, and even social inequality. Then you have the absolute bleeding-edge third-generation clocks, like Dunedin pace. This thing acts like a biological speedometer, tracking your exact physiological pace of aging per calendar year. If you're an investor vetting a biotech startup, these are exactly the readouts you demand to see. Moving into Section 4, the VC ecosystem. Now that we've got a handle on the clinical science and the metrics, let's map out who is actually driving this forward. The current venture landscape is incredibly stratified. On one end, you have massive, multi-stage heavyweights like Khosla Ventures dropping serious capital across cellular reprogramming and diagnostic platforms. Then, you've got highly specialized thematic funds like Apollo Health, zeroing in purely on fundamental aging pathways like mitochondrial restoration. And what's absolutely vital for feeding the early pipeline are specialized funds like Age One. They're the ones writing those crucial $500,000 to $4 million checks for pre-seed and Series A startups to get that early stage validation. This sheer diversity in funding, from early seed all the way to mega rounds, is the classic hallmark of a maturing and resilient biotech sector. Finally, Section 5, the macroeconomic prize. If these scientific and financial bets pay off, how big is the market we're really looking at? Let's zoom out. It's absolutely crucial to realize that we are way beyond just biotech venture capital at this point. The impact is literally rippling through the global financial system. The insurance and reinsurance markets are fundamentally restructuring to manage the financial realities of extended life expectancy. We're seeing a huge surge in the life settlements market as seniors sell policies to cover long-term care. Over in Europe, Dutch pension reforms are rapidly pushing insurer to reinsurer transactions to offload the massive financial risk of people living longer than their models predicted. The broader financial world is already actively hedging its bets on the success of longevity medicine. And here is exactly why. The economic implications of this science are frankly staggering. We are looking at a macroeconomic scale of $38 trillion. According to macroeconomic models presented by researchers like Dr. David Sinclair, extending the healthy health span of just the U.S. population by a single year generates $38 trillion in economic value. Why? Because you're doing two massive things at once, boosting the productivity of an aging workforce while drastically reducing the astronomical healthcare burden of late-life multimorbidity. When you dig into these models, it becomes crystal clear. This isn't about some sci-fi quest for immortality. It is about preserving human function, turning the massive liability of an aging population into an unbelievable macroeconomic asset. So as we wrap up this explainer, I really want to leave you with a thought. We've looked at the billion-dollar mega rounds, the clinical pipelines mapped out, and the advanced epigenetic KPIs. Aging is no longer just this inevitable biological decay, it's a druggable target. As you review your own market strategies and healthcare assets, ask yourself, how are you weighing the risks and the truly unprecedented macroeconomic rewards of the translational geroscience space? Is your portfolio actually positioned for the biological revolution? Something to think about. Thanks for tuning in, and we'll catch you next time.